you look at the accounting system, so far we've spent a lot of time on transaction analysis. It's really the most important part of the accounting system. In this session, we're going to tie transaction analysis into the rules for debits and credits. Then we're going to create journal entries in an accounting book called the General Journal. When we look at the rules for analyzing transactions, there are really 3 steps that we want to incorporate. We're determining which accounts are changing. We're determining if the accounts are going up or going down. And then we're going to apply the rules of debits and credits. If you recall from the last session, we summarized the rules for debits and credits with the acronym wax up debits and clear up credits. Remember that the W stands for withdraws, the A for assets, and the X for expenses. Those 3 types of accounts go up with debits, and the implied part of that rule is that when they go down with credits. If you look at the second part of the acronym CLEAR, we have capital. Remember, C stands for capital, not cash. The L is liabilities, and the R is revenues. Capital, liabilities, and revenues go up with credits. And if those accounts are going down, they're going to go down with debits. With our first example, the owner is going to invest $10,000 in the business. When we analyze transactions, the first thing we have to do is determine which accounts are going to change. When we look at this transaction, we see that word invest, and we know from previous sessions that when we see that word invest, we're going to put that in the owner's capital account. So that's the first account that's going to change. The second account is really implied, so this one's a little bit more challenging. You have to ask yourself, what is the owner investing? And the owner is investing $10,000 cash. So that's the second account that's going to change in this transaction. So we have cash and we have capital. Now, before we start to apply the rules for debits and credits in this transaction, we're going to bring our acronym in. I usually write it right on the top of my paper so I remember what it is. And we're going to relate the types of accounts that are going to change to the acronym WAX and CLEAR. When we look at the T account for cash, we know that debits are always on the left and credits are always on the right. Now we have to look to the rule to determine what debits and credits mean for the cash account. So cash, we know, is an asset. So that means that assets go up with debits and down with credits. So a debit makes cash go up and a credit makes cash go down. When we have a look at the capital, we know that C in CLEAR relates to the capital account. Remember, C is not cash, it's capital. So when we look at the T account for capital, we know that our debits are always on the left and our credits are always on the right. But when we look at the rule clear up credits, we know that for capital, credits make the account go up and debits make the account go down. Now we go back to the transaction and we read it again. The owner invests $10,000 cash in the business. You have to determine if cash is going up or is it going down. The business is getting $10,000 more cash than it did before, so cash is going up. We're going to write the $10,000 on the debit side of the T account. When we have a look at capital, we know that the value of the business is increasing because when an owner invests money in the company, the value of the company or the book value of the company goes up. So we're going to place that $10,000 on the credit side of the T account. When you apply the rules of debits and credits to a transaction, debits and credits have to be equal. So if you debit something for $10,000, you have to credit something for $10,000 as well. In example number 2, the company is purchasing supplies by paying $2,500 cash. So when we look at the transaction, there's a key word right there, cash. We know the cash is going to change. So we're going to have a look at the cash account. And the other thing that this transaction is telling us is that we're purchasing supplies. So supplies is the other account that is going to change. We'll pull in the supplies T account. With T accounts, remember, debits are always on the left and credits are always on the right. Doesn't matter what type of account it is we're talking about. Debits are always on the left, credits are always on the right. But debits and credits mean different things for different types of accounts. And that's where WAX and CLEAR come in. For all withdrawals, assets, and expenses, they go up with debits. Capital, liabilities, and revenues go up with credits. So we have to take the T account that we're working with and apply the rules to the debits and credits. So cash, we know, is an asset, and with assets, they go up with debits. So debits go up, credits go down. With supplies is also an asset. So the same rule applies here. Debits go up and credits go down. Now we go back to the transaction to determine if the company's cash is going up or down when they pay for something. And the answer is it goes down. So we're going to put that $2,500 on the credit side of the T account. With supplies, the company is purchasing supplies, so they had more supplies than they had before. So the supplies account is going up. And we're going to put that $2,500 on the debit side of the T account. Remember that every transaction has to have debits and credits that are equal. In this third example, the company is purchasing supplies for $1,100 on credit. When we have a look at the accounts that are changing, we know that supplies is an asset account, so there's one of them. And then we have this phrase to determine what the other account is. We have on credit. Remember, when it's a purchase on credit, it relates to accounts payable. When it's a sale on credit, or we're doing work for our customers on credit, that's accounts receivable. So in this example, our two accounts are supplies and accounts payable because we're purchasing something on credit. We need the rules for debits and credits. When we look at the T account for supplies, we know that supplies are assets. So our debit is going to make supplies go up, and our credit is going to make supplies go down. For accounts payable, remember accounts payable is a liability, and debits make a liability go down, and a credit makes the liability go up. That's what our rule says, liabilities go up with credits. When we go back to our transaction, the company purchases supplies for $1,100. You have to ask yourself if the supplies account is going up or down. And when we purchase supplies, our supplies account goes up. So we're going to put that $1,100 on the debit side. When we look at the accounts payable transaction, you have to ask yourself, is the company's debt going up or down? And when we purchase something on credit, the company's debt goes up. So we're going to put that $1,100 on the credit side of the T account. So every transaction has to have a debit and a credit that are equal. So we have our debit and supplies and our credit and accounts payable. Once we complete transaction analysis, we have to take that transaction and put it in the company's records. The first point of entry into a company's accounting system is the general journal. This general journal is a book that contains all of the transactions of a company. So I'm going to bring in an example that we've had a look at already, and the example is this. The owner invests $10,000 in the business. When we look at this transaction, we know the two accounts that are going to change are cash and capital. When we read the transaction, we know that the company's cash is going up by $10,000. And when you relate cash going up to debits and credits, according to WACS, assets go up with debits. So this is our debit. With capital, when the owner invests money in the business, the capital of the company goes up as well. And when we look at the rule for clear, capital goes up with a credit. So we're going to debit cash and we're going to credit capital. We have to have the transaction analysis done before we complete the general journal because we have to put the information in the general journal in a certain way. The first thing you do is fill out the date of the transaction, and I'm just going to make up a date, and I'm going to say January 1st. In the account titles and the explanation, we're going to put the account that is debited first. So in every journal entry, the account that is debited is going to go first, and that happens to be cash in our example. We're going to ignore the PR column for now. PR stands for post-reference, and we'll do that in another lesson. Then we're going to put the $10,000 in the debit column. The next thing we're going to do is deal with that capital account. Every time we put a credit into a general journal, we're going to indent and we're going to write the word capital. We know that capital is going to be credited, so we're going to put that $10,000 in the credit column. So there we have a journal entry. We have cash being debited and capital being credited. Remember, every transaction needs debits and credits that are equal. So in your journal entry, it's very easy to tell if you have debits and credits that are equal. The last part to the journal entry is an explanation. So underneath the word capital, you're going to write investment by owner. So in your general journal, once you've completed that transaction, you're going to skip a line and go down to your next one. In our second example, the company is purchasing supplies by paying $2,500 cash. When we read the transaction, we know that cash is one account that is going to change, and the other is supplies. When we have a look at cash, we know that the cash of the company goes down when we purchase something. We also know that cash is an asset, and when assets go down, according to the rule, that's a credit. Remember, we wax up debits and clear up credits. With supplies, we know that when the company is purchasing supplies, the supplies of the company go up, and supplies are also an asset. So when we apply that rule to wax and clear, we wax up debits. So there's our A in wax. So this one is going to be our debit. Remember, you have to do all of that before you put pen to paper in your general journal, because when we do that, we have to put the debit account first. So we're going to put supplies, and the $2,500 is going to go in the debit column. Don't forget our date. I'm just going to make one up here, January 2nd. Then we're going to indent and put our credit second. And the $2,500 is going to go in the credit column. An explanation of the transaction could be company purchase supplies. The explanation for a transaction can be explained in many, many different ways. So don't be concerned if your explanation isn't exactly what they put in the suggested solution. As long as it means the same thing, your explanation